Now we're gonna look at the bond market. It's the most exciting thing ever! I promise you. It's where interest rates are set, and it's probably the most confused area of finance that is so important. It's where credit is created. And that's how you sometimes need to finance things, but it's also so incredibly misunderstood. And I'm gonna debunk all the mysteries, and you're gonna totally enjoy it. See you in the video. The bond market is where interest rates are set and where credit is formed. And it's little understood, yet so immensely important to the national standard of living. And that's why we're going to study bonds in this section. Most people don't study the bond market because it's either too complex or too uninteresting for most individuals to actually pay attention to. Because of this, many individuals miss the point and therefore miss the many opportunities that the bond market actually offers, both in making investments and obtaining credit. The bond market enables home mortgages or other forms of credit such as home equity loans, credit cards, personal loans, or even car loans. Sometimes loans or debt is used for good, but what's not good is the explosion in consumer debt over the past couple decades that has really caused a cultural phenomenon. Borrowing money to make yourself more productive is a good thing, but when you borrow money, for example, for a television, that does not improve your productivity, and it's actually just borrowing from your future self. Because a lot of companies are leveraged, meaning that they have taken on debt in the form of bonds, the stock market and other asset classes watches the bond market as a hawk. It's no wonder that one of the most famous advantages in the stock market, or sayings in the stock market, is do not fight the Fed. After all, the Federal Reserve has a printing press. And in 2009, the Federal Reserve actually pumped in over $1 trillion of cash into the markets. As a result, the Standard & Poor's, the S&P 500, actually gained 23.5% as a result. Fitch, Moody's, and Standard & Poor's, they all do different types of credit investigations. They rank the bonds from very safe to junk, and we'll look at that shortly. Let's keep the terminology simple. Bonds are securities that obligate the issuer or the borrower, same name, to make specific payments or interest rates payments to the holder, which is the lender, over a period of time, and par value is paid at maturity, which is called principal. A plain vanilla bond with a specific coupon rate and maturity has no options attached. A zero bond is a bond sold at a large, deep discount from face value because there's no cash flows until maturity. Now, a bunch of the terms that are important to pay attention to is that the face or par value is typically a multiple of 1,000. Sometimes they will use 100, but typically it's 1,000. The coupon rate is the interest rate that you're paying. The maturity is the time periods. The indentures include positive and negative clauses. Here's an example of different types of credit ratings from Moody's, Standard & Poor's, and Fitch. So AAA is good. That's prime. That's the best you can get. Now, then it goes down to BAA3 or BBB minus or BBB minus. They're all the same, and which means that you go from prime rate to lower medium grade. This is also called investment grade. It's important to understand what that is because insurance companies, some pension funds, and some other entities that are heavily regulated are only allowed to invest in investment grade bonds. Things that are beneath this is non-investment grade, also referred to as junk. Well, everything is not as junky as triple D here, which is in default, but some are just simply speculative by nature. An interesting area is when you have bonds right here that is just over the border of non-investment grade and deemed as speculative. Now, when they get an upgrade, typically it means that a lot of organizations on the investment grade side has to buy it, which means that they will typically pay a little bit of a premium over what you actually bought that bond for. So, fixed income. The bond market is where interest rates are set. It's a very volatile market. It goes up and down all the time. And the interest rate determines the price of the underlying security. All interest rates are quoted on loans, credit cards, savings accounts, money markets, and so on are all linked to the bond market. Mortgage rates are tightly correlated to the yield of the 10-year Treasury note, for example. The bond market is either too complex or too uninteresting for most people to actually want to pay attention to it. But if you're investing, again, do not fight the Fed. When they make a decision, the markets pay attention, and it will either cause the market to rally or drop like a stone. The Federal Reserve issues reports on a 6 to 2 months basis called the Beige Book. It is a summary of everything that is happening in the economy. It looks at a macro point of view, but it also looks at the 12 different Federal Reserve districts. It's an excellent spot to actually find out what is going on in the economy. It's split up in different sectors as well. So if you're working on a SWOT analysis, you should look at the Federal Reserve Beige Book because it will give you the best information available for the sector that you're drafting a business plan for. FINRA has a trading reporting engine called Trace, and it facilitates the mandatory reporting for all the over-the-counter and secondary market transactions. It's a great spot to go to look up fixed income products and bonds. So you can go to FINRA, or you can go to FINRA's Morningstar-backed database and look up bonds. And the most important part is that you can look up and screen bonds and find out what it is that you're interested in. Grab the QSIP and then take that and buy it. The QSIP is a unique identification number of the bond issue, just like a stock ticker for stocks. The Government National Mortgage Association, or known as Ginnie Mae, offers mortgage-backed securities to investors. It's a way for them to raise funds and take those funds and then, through their program, allow banks to write loans for people who are buying their first home. Now, Ginnie Mae is a government-sponsored agency, which means that they will actually be protected by the full fate of the U.S. government. So if they have any troubles, they will get a bailout on the expense of the taxpayer. So you can either invest in a mortgage-backed security by going to Ginnie Mae and writing a $100,000, $500,000 check, or you can go to the open markets and the stock market and buy an ETF that is actually a representation of Ginnie Mae's mortgage-backed securities. American International Group, AIG, is a huge insurance company. They have more than 90 million customers all around the globe. So they will actually offer insurance on fixed income products or securities that guarantees the payments. That's a way to risk mitigate anything that is not deemed investment grade. To better understand bonds, you need to understand what the risks are. So default risk means that you won't get your money back, okay? They're defaulting. They can't pay, or they can't pay on time. Another one is credit spread risk. Even if a bond issue does not go into default, there is a risk that the market value of the bond will fall because the return demanded by the market has increased. Now, when yields increase, the value of the bond will decrease. So when yields decrease, the value of the bond increases. Now, the value of the bond can also change in value if the credit risk changes. A downgrade risk means that the risk of a bond issue to be rated lower. If it actually goes down to non-investment grade, then a lot of organizations and pension funds and so on will be forced to sell it. And when lots of people sell something and no one wants to buy it, the price goes down. Liquidity risk is that there might not be any buyers for the bond that you have, meaning that you will actually have to sell the bond for a lower price than you maybe would like to. Inflation risk, that causes the interest rate to go up, or if it's deflation risk, go down. So it causes volatility. So with inflation risk, causes a purchasing power risk from the decline in value of the bond's cash flows. Now, if the bond has embedded options into it, the volatility risk and the fluctuation of interest rates will sometimes cause the bond to decrease rapidly when expected yields change. Event risks are those special events that might happen, like a natural catastrophe, or a corporate takeover, or a change in government regulation. All those events will have an impact on a bond. Now, another one that is new that we have to actually add into the risks are those invisible risks, such as a virus. Sovereign risk is the risk that results that a foreign government might change the rules or even simply confiscate the assets. Here's an example of different bonds. So here you have Airgas, Bristol Myers Squibb, Campbell Soup, John Deere, Emerson Electric, and so on. So here you have the interest rate that is stated on the bond. Okay, and here you have the maturity of it. This is the QSIP, and that's the ticker symbol for the unique bond issue. And right here, you have different prices. So depending on the yield, these will go up or down. So anytime you have an interest rate and the price is above, that's called a premium bond. Now, when the price is less than 1,000, it's called a discount bond. The reason why some bonds cost more is because you have to make up somehow for the higher interest rate that you're giving up. If you sell this bond, someone has to pay a little bit of a premium to get the 6% interest rate if the interest rate is, for example, very low and significantly lower than 6%. To better understand how prices are changed on bonds, you have to understand something called duration. So duration is the value of the bond, and it creates a sloped curve like this. So assuming that we have a 30-year 5% bond, and if the interest rates are matching up at 5%, we will pay exactly $1,000. However, if interest rates are lower than 5%, then you will pay higher. So in this case, if interest rate happen to be exactly 0%, you'll pay $2,500 for that 5% bond. Now, on the other hand, if interest rates are very high, then the price of the underlying bond will decrease. So if it goes all the way up to 10% on interest rates, then you could buy that bond for $500. Now, at $500, that gives you, yes, less rate of return than 5 versus 10, but $500 will double over the timeline of that bond, which means that you will actually double your money just on the bond price. Now, the volatility changes all the time, back and forth, which causes the bond price to change up and down on a consistent basis. It's because of duration. Most people don't understand bonds, and they typically don't make money on bonds. They just assume it's something safe, but they don't understand why it's safe or why it's not safe. Now, after learning this, and understanding duration, you understand how volatile and risky bonds actually are. My recommendation for you right now is to watch this movie. The video, How the Economic Machine Works in 30 Minutes by Ray Dalio, is available in my playlist. I hope you liked this video, and if you did, give me and follow my page. I also suggest that you take a look at my playlist that has awesome, fantastic videos on stuff that you want to watch. Okay, lots of good econ stuff. People like Ray Dalio, Milton Friedman, Carl Icahn, Shark Tank, and other episodes that I think you're gonna totally enjoy and help you better understand the economic world that we live in. So, see you soon. Take care. Bye-bye.